Kremlin is cashing in. Despite the tightest sanctions in modern history, Russia just raked in more oil revenue than at any point since tanks rolled into Ukraine. Moscow is moving more barrels, prices are climbing, and the West's strategy to starve Putin's war machine of cash is quietly unraveling. Here's what you need to know. Russia's oil exports surged in value to their highest level since the invasion began in February 2022. We're talking about a double tailwind. Volumes are up and prices are stronger. Bloomberg data shows Russian crude and refined products hitting export levels not seen since before the sanctions dragnet tightened. This isn't just a blip, it's a sustained rebound that's pumping billions back into Russian coffers, directly funding military operations in Ukraine while the West watches with limited recourse. Why now? OPEC plus production restraint by Saudi Arabia and Russia itself has kept global supply tight. Brent crude has been trading above $80 a barrel, well above the G7 price cap of $60 meant to choke off Russian revenues. But enforcement is patchy. A shadow fleet of aging tankers, uninsured and operating under murky ownership, is bypassing sanctions. Russia ships to willing buyers in India, China, and Turkey who aren't bound by Western caps. Discounts have narrowed, meaning Russia gets closer to full market price. Meanwhile, European bans have been absorbed as Asian demand soared. Global oil markets are reacting with guarded optimism about supply stability but concern about geopolitical risk. Brent and WTI futures have held firm, and that benefits all oil-producing nations. Energy stocks in the US, Europe, and Asia are seeing tailwinds. Majors like ExxonMobil, Shell, and Chevron have enjoyed strong share performance. But the flip side? Higher crude prices mean higher gasoline and diesel costs worldwide. Inflation pressures that central banks thought they had tamed are stirring again. The euro has weakened slightly against the dollar as Europe absorbs costlier energy, while commodity currencies like the Norwegian krone and Canadian dollar have strengthened. Who wins? Obviously Russia. Its government revenues are up, budget deficits narrow, and the ruble stabilizes. Oil service companies, refiners, and shipping firms involved in the shadow trade profit handsomely. China and India get discounted crude, boosting their refining margins. Energy exporting nations from the Gulf to West Africa benefit from sustained high prices. Who loses? European manufacturers face rising input costs, squeezing margins. Airlines globally see fuel expenses climb just as travel demand rebounds. Consumers everywhere feel it at the pump and in heating bills. Emerging markets dependent on energy imports face balance of payment strain and currency pressure. Europe is the most exposed region. Its pivot away from Russian energy was costly and incomplete. Germany's industrial engine sputters under high power costs. Contrast that with the US, insulated by domestic shale production, though consumers still feel pain. Asia, particularly China and India, emerge as strategic winners, leveraging their neutral stance to secure energy at favorable terms. Sanctions fatigue is setting in among Western allies, and enforcement gaps widen as economic self-interest trumps solidarity. This surge complicates labor markets in surprising ways. High energy prices dampen economic growth in net importing countries, slowing hiring. In energy exporting regions, job markets tighten. Houston, Calgary, Aberdeen see wage pressures in oil services. Real estate, energy hubs are hot. Property values in Texas and the Gulf states benefit. Conversely, European industrial towns face stagnation as factories scale back. Watch crude prices closely. Any move above $90 could force the Federal Reserve and ECB to rethink rate cuts. Monitor the G7's next meeting for any tightening of the price cap or sanctions enforcement. Keep an eye on China's economic data. If demand there weakens, Russia's bonanza could be short-lived. And watch for diplomatic shifts. Sanctions only work if everyone plays along and cracks are showing. Stay informed, stay ahead. This is World Financial News.